One of the most common problems and concerns business owners have is how to choose between the various types of business entities. In this video, we'll give a better and more helpful guide to helping you in considering these choices. You are prepared to start your own business. You have a brilliant strategy and a great group of people. You've given your strategy a lot of consideration. It's all ready to go. You're prepared to establish a legal entity, but you're not sure what kind of business entity is most appropriate for your new company. It can be hard to decide between the multiple options. No type of entity stands out as the ideal one. The best option for one company might be terrible for another. Each type of entity has its own set of legal and tax implications that can make the head of even an experienced practitioner flip. To a good degree, the selection of entity gets down to a few significant elements. How taxes are put on profits. How hard and how much will it cost to establish the entity, and how will it be governed and run in the future? And the protection from liability, especially from the owner's own assets. Each entity type is distinct from the rest in at least one of these ways. To find the best fit, you need to understand the advantages and drawbacks of each choice. Let's go over them one by one. Sole proprietorship. By far the easiest way to run a business is a sole proprietorship. There isn't much of a plan. If you are a sole proprietor with no staff members, you don't have to register with the IRS. As the business tax ID, they can use their social security numbers. Despite what many people think, you don't have to incorporate your company to extract business costs. If an actual company starts up without formally incorporating, it is naturally a sole proprietorship or a partnership if there is more than one owner and can subtract its business costs as such. The owner can pay themselves a salary. They just take out the money when they require it. Every year they have to pay income tax on the company's taxable profits, whether they've taken the money out or not. Most of the time the profits are taxed by the federal government and Social Security and Medicare. There is an interesting detail. FICA tax is 15.3% of revenue up to the Social Security limit of $128,400 and 2.9% of revenue above that. A lot of small business owners discover that they owe more in FICA taxes than in income taxes. Sole proprietorships are meant for simple businesses with only one owner. Think of freelancers, advisors, small companies that provide a service, food vendors, etc. Sole proprietorships do not possess shareholdings or owning units, indicating that one escape choice would be to sell the business's assets. S-corps. Partnerships and sole proprietorships are less appropriate for large and lucrative firms. S-corporations are ideal for smaller and mid-sized private firms. Before understanding S-corporations, here's a central idea. Pass-through. It includes entities, S-corporations, partnerships, and proprietorships. Their taxable income passes through to the owner's personal taxes for taxation. S-companies and partnerships file tax returns but bear no taxable income. Form K-1 assigns the business's taxable income to its shareholders. Each owner's K-1 payment is taxed on Form 1040. Single-owner businesses don't file tax returns. The company income is estimated on the owner's Form 1040, Schedule C, E, or F. Why is pass-through important? Pass-through entity owners pay personal income taxes on business profits, but can receive them as tax-free dividends. Why is the S-corporation form chosen if a partnership is a pass-through entity? Due to FICA tax. S-corporation owners must pay themselves a fair salary, but the leftover revenues are only subject to tax, not FICA. Imagine a $1 million a year business. Say the owner gets $100,000 and the rest is profit. Even one solo entrepreneur with no workers must pay and file income tax returns with the IRS. Unlike a sole proprietorship, partnerships can pay payroll compensation to shareholders. S-corporations have harsher requirements than others. For example, an S-corporation shareholder must be a U.S. citizen or permanent resident. This disqualifies businesses from pursuing corporate or international investments. Earnings and payouts must be apportioned by ownership and limiting loss utilization. S-corporations have a limit of 100 stockholders. S-companies are much more complicated than proprietorships and often need an attorney or accountant. This raises maintenance and setup costs. C-corps. Growing firms may exceed the S-corporation structure. If you have more than 100 shareholders or need distinct share class structures, an S-corporation won't work. C-corporations are all major American public companies. It's their own entity type. Few privately held C-corporations choose the structure for purposes apart from income taxation. Rising entrepreneurs seeking serious investment use C-corporations. Targeted shareholders may be businesses or foreign individuals who can't invest in an S corporation. C businesses pay their own taxes. This differs from the three pass-throughs that pass income to shareholders' tax returns. C corporation shareholders must typically pay tax on any dividends they extract. The C corporation initially pays tax on its income, and the shareholders pay tax on the remainder. Most private enterprises avoid C corporation structure because of double taxation. C corporation losses can't be subtracted from shareholders' other earnings. Some private investors may find that significant. Despite the dual tax, the C corporation structure may be tax efficient for smaller private firms. For a C corporation, income is taxed at 21% due to solid growth. Extracting dividends and paying a second tax is unnecessary. Certain C corporation shareholders can leave tax-free, countering the last point. In some instances, the C company structure might be tax efficient. The drawbacks outweigh the benefits for most small to medium-sized organizations. The 2018 Tax Cuts and Jobs Act gives C businesses additional perks. This law limits taxpayers' ability to subtract state-imposed income taxes. C corporations pay their own state income taxes and aren't limited. Therefore, they're more appealing in high-tax jurisdictions. States are still responding to the new legislation so that alternatives may develop. LLC. Why didn't we begin with LLCs initially, since so many companies are set up as LLCs? That's just because the LLC is a diamond throughout this list. The IRS does not acknowledge an LLC as a tax-paying company structure since it is only a legal entity. For tax reasons, the shareholders of an LLC should select one of the other structures. It is okay to set it directly up as any of the four tax entities instead of an LLC, so why would anyone select the LLC? To put it another way, why does it appear that mostly every new business today is set up as an LLC? Compared to sole proprietorships, the framework of an LLC actually protects the owner's personal assets from the lawsuit brought by the company. The LL in LLC stands for limited liability, which tells everyone that the holder is not solely accountable for assertions. Overall, an LLC framework is easier to manage than a straight S or C corporation. For instance, actual corporations usually have to grab annual conferences and keep seconds of those conferences. Most of the time, these rules don't apply to an LLC that is taxed as a corporation. Starting as an LLC gives a business the freedom to switch to a different type of business afterward. For instance, one common way is to start an LLC that is taxed as a partnership and then switch to an S corporation when the business starts making money. Taxes don't change because of the LLC umbrella, except in rare cases. Any LLC still has to choose, for tax reasons, whether this wants to be a C corporation, an S corporation, or a sole proprietorship. So if your company is simple and tiny and you don't anticipate that you'll earn substantially more than a fair wage, you can establish an LLC that is taxed as a sole proprietorship. In this situation, the advantages of being an S corporation probably won't be worth more than what it will cost you to do your own payroll and file a distinct business tax return. If you are beginning a traditional business with co-owners and staff, you can start with an LLC taxed as a partnership and switch to an S corporation when the business begins to make money. This gives you the freedom of a partnership right away and keeps you from paying FICA tax on profits once they come in. Consider a C corporation centered in Delaware if your company is a new, trendy startup looking for serious financing and a general populous exit. This video is meant to give entrepreneurs a fair overview of their choices and help figure them out in the right way. If you're on the verge of selecting a particular entity type, talk to your tax attorney to get advice about your specific case. Thanks for sticking around till the end of the video. If you enjoyed this video, smash the like button and subscribe to our channel for more awesome videos just like this.